Welcome to the Phuble podcast, where we talk about all things relating to the financial markets around the world. I am Philemon Viennes, and this podcast is sponsored by Phuble, the social networking application for any and all investors. It is Saturday, August 25th, so we're going to be going over the previous week. Let's get right into things. The indices were crushed on Friday. I think all indices were down about 3%. And I'll get into those reasons a little bit later, but the Dow Jones dropped to 25,628. The S&P 500 dropped to 2,847, and the Nasdaq Composite Index dropped to 7,751. Like I said, all these indices were dropped down around 3%, and that was due to the rise again of the China-U.S. trade war. China stated that they were going to raise tariffs on U.S. goods, and then Donald Trump retaliated on Twitter and said that the U.S. was going to raise tariffs on Chinese goods. I'll go over those numbers in a minute, but let's just go through gold and oil. Gold increased off this news and the nervousness of investors in the market. The gold spot index is at 1,526, and the COMEX raised to 1,537. Look for gold to continue to go higher, especially once economic slowdown hits at the end of the year, and also when the tariffs hit the Chinese goods in December. Oil decreased substantially off of the tariff reports on Friday. WTI dropped to $54.17, and Brent dropped to $59.34. Like I said in the previous podcast, oil is probably going to be floating around $55 to $65 going into the end of the year. It's definitely not going to go up any higher, especially since there's going to be these tariffs that are going to be implemented very soon on autos, and I think also crude. So that's probably going to decrease the demand. So the market is going to anticipate that that's going to decrease the demand of oil. So these prices are probably going to fall probably closer to 55 than 65. But if there's instability in the Middle East with Iran and they do decrease output for some reason, the prices will probably go up to closer to the $65 range. But I anticipate going into the end of the year that oil will probably remain closer to the $55 mark. So the U.S. and China, what exactly happened? First off, let me just say that I believe the markets going into the end of the year are going to increase still. I think the Dow is going to go up past 26,000. I think the Nasdaq is going to go up past 8,000. I think the S&P is going to go back up past 3,000 like before. I think the market really aggressively attacked this trade war. I think it's going to get figured out. I don't think these tariffs are going to be implemented in full effect. I think they're going to be pushed back, especially if they have a bad effect on the economy, a negative effect on the economy, which they will, definitely. But there are other factors too that probably will affect these indices and the stock market as a whole. For now, though, I'll say that I do assume that all major indices are going to go up. I think the stock market generally is going to be positive going into December and the rest of the year. So for these tariffs, I'm going to read these off. This happened Friday. Beijing announced that it was going to implement a 5% or 10% tariff on $75 billion worth of American imports starting September 1st. Donald Trump saw that and tweeted that American companies should find alternatives to producing goods in China. That was the first real market sell-off that happened on Friday. He then went on to say that the U.S. will raise their tariffs from 25% to 30% on $250 billion of Chinese goods starting October 1st, and they're going to increase their tariffs from 10 to 15% on the remainder of the $300 billion goods from China in December. Those were the tariffs that were supposed to start in September, but they were pushed back to December. 15% on $300 billion worth of Chinese goods and 30% on $250 billion worth of Chinese goods. Those were the two increases on the U.S. side. And then China stated that they were going to place tariffs on an additional $75 billion of American goods. And they're deciding whether that's 5 or 10%. They have to figure this thing out. They really do. Both economies are going to suffer. The world economy is going to suffer. The global economy is going to suffer from this. I mean, there's no other way to put it. They really need to just sit down and figure this out, but I don't think they will until after the presidential election. I can almost guarantee China is not going to agree to anything before the election. And Donald Trump is not going to give way going into the election. But they should, because it's just going to hurt the economy. Not going into the end of the year, but definitely if this thing persists, definitely at the beginning of next year, it's going to hurt. And you're going to see companies with reduced earnings. You're going to see a decrease in consumer spending in China and in the U.S. especially because of this. And that's not good. That's not good at all. Sticking with Donald Trump, he criticized Jerome Powell once again on Friday. And if you didn't know, the U.S. Fed banks were meeting in Kansas City for the Federal Reserve Bank of Kansas City annual symposium this past week. Jerome Powell spoke on Friday. Basically, the symposium is just to get all the Federal Reserve banks, the district banks, together and discuss policy. Jerome Powell stated that the Fed would look to cut rates to achieve low unemployment and stable inflation. He didn't say that the Fed was going to cut rates in September. Remember, the Fed cut rates just a month ago in July to between 2% and 2.25%. That was the range. The market's anticipating them to cut again in September for the 1.75% to 2% range. Jerome Powell didn't say they were going to cut rates. He just kind of suggested that the Fed would cut rates to meet their goals and to stimulate the economy. He didn't really sound dovish in the sense that he was guaranteeing a rate cut, but it's most likely going to happen. Now, Donald Trump responded to that saying he didn't know who the bigger enemy was, Jay Powell or Chairman Xi, referring to Xi Jinping, the premier of China, the president of China. So he went out and just attacked Jerome Powell. Honestly, I think he thought that this meeting in Kansas City was to determine interest rates, and it wasn't. That wasn't what the meeting was for at all. It was not a interest rate meeting. It wasn't. But I think Donald Trump thought that. And I think he thought that Jerome Powell was going to state that the Fed would be cutting rates, and that's why he sent that tweet out. I don't agree at all with his criticism of the Fed. The Fed needs to do their job. The president needs to do his job. They are separate entities for a reason. When that becomes mixed, when those two elements become mixed, you get a state of uncertainty for them to be clear-cut in their decision-making and actually put forth the best methods, because their interests are diluted, and they're not supposed to be diluted. They're supposed to be independent. They do not need to have the president telling them what to do. These are the smartest economists in the United States, possibly the world, that work for the Fed. And they know what they're doing. It's hard. It's a very difficult job because the economy moves faster than data can predict or even show what's happening. So they try their best to keep ahead of the economy, but in reality, most of the time they're behind because they don't have all the data. They can't. It's real-time data. It changes every single minute. It's impossible to actually know where the economy's at. And the stock market is not that great of a judge of the economy. The economy is one thing. The stock market is another. I mean, they're two separate things. They're two separate entities. Donald Trump really uses the stock market to gauge on what the Fed should do, and the Fed uses economic data. I trust the economic data that the Fed is using. I really, really hope Jerome Powell, going into this next meeting, looks at a Fed rate cut in the best interest of the economy and not the best interest of the president and the stock market. I really do, because you can cause unintended inflationary effects on the economy if you think that the stock market represents the economy in the sense of a dovish response. So in the sense of a rate cut, and you're looking at the stock market, you can really drive an economy into inflation. That's not what he wants to do. Is there global economic slowdown? Yes. Can inflation still be caused in the United States? Absolutely. If the economy is moving forward at a positive pace, and that's what the data shows, and then you cut rates, that can drive inflation upwards, and you don't want that. I know there's a slowdown in inflation. The Fed target of inflation is 2%. It's a little bit lower than 2% right now. You don't want to cut rates and drive that above 2% because then you'll have a very, very bad problem. You also don't want to hit consumer burnout, which I'm afraid it's going to happen with this economy. So I really hope Jerome Powell cuts rates in the future because of economic data, not because of the president. Because we all know that the president wants him to cut rates, but I hope he bases it on the data, and that enemy comment that the president made is completely disrespectful to the chairman, Jerome Powell. It's completely disrespectful, and I don't appreciate him doing that at all. And basically those events that happened with the president caused the spike in gold, decrease in the indices, and the decrease in oil. Gold is definitely going to keep increasing throughout this volatile period. Whenever there's uncertainty in the market, investors flock toward gold. It's a safe haven. It's always been a safe haven and always will be a safe haven. Bitcoin is also, I think, going to become a safe haven. Definitely gold, though. Definitely gold is a fantastic investment going into 2020, 2021, 2022. I think by 2022, gold is going to increase probably 65% the price that it's at now. And if there's a lot of uncertainty, look for it to increase to plus 100%. I really believe that's going to happen because it's a safe haven. I'll stick with Donald Trump for one other story because this was also big. So you can see the dollar spot index behind me. It declined on Friday. And over the past year, the dollar strength has been increasing. Basically, that means that the dollar is valued more than other currencies. That's good for people who are investing in the dollar. That's bad for people who are selling American products to foreign nations. So that's bad for exporters. Donald Trump has claimed that China has manipulated its currency and that Europe now is doing the same thing. He has threatened to essentially manipulate the dollar and drive the dollar strength down so that U.S. exporters will essentially earn more and be more favorable to foreign countries. It's never good when a country or a group of countries manipulates their currency. It's not. I mean, you're just asking for terrible economic consequences. And I don't want him to do this. I really don't want him to do this. Does China manipulate their currency? Probably. Does Europe manipulate their currency? I doubt it. Both Europe and China are having economic slowdowns, so that is also contributing to their to the decrease of the euro and the Chinese yuan. Also, Britain is having their issues with Brexit, contributing to the decrease of the Great Britain pound. I do not like the fact that he's making these statements. I think it's dangerous to manipulate a currency. I mean, you're just asking for inflation. And I don't like that at all. That's why the dollar spot index dropped. It was hovering, I think, around $98. It was hovering around 98 before he made that comment. And then it dropped, as you can see, 0.5%. I don't like that. I think that it's dangerous. I think that he's willing to manipulate the currency. The dollar is still a safe investment. It's always going to be secure. But I would not invest in the dollar right now. I would go to gold. I would definitely go to gold. When he made that comment, I didn't trust the investment in the dollar anymore. I just didn't. And Jerome Powell actually alluded to that and the trade war as factors that the Fed couldn't control. I think that's also another reason why the president got mad at him. And he's right. He's right. The trade war is going to have a negative impact on the economy, and the Fed can only do so much. Let's jump into a couple of stocks. We're going to jump into two big ones. Tesla was in the news this week. Walmart sued Tesla for faulty solar panels. Apparently at 7 Walmart stores, Tesla's solar panels caught on fire. Remember, Tesla bought Solar City back in 2016 for $2.6 billion. It's been implementing in solar panels on stores, and I believe also in cars, in the Tesla cars. There was a faulty connector, and Tesla said that that faulty connector was in less than 1% of the products that were produced, and 1% of the Tesla solar panels that were produced. David Einhorn, who is a hedge fund manager, he's a hedge fund investor, he called for Elon Musk's resignation over the company's solar panel issues. Elon Musk is not going to resign. He's not. David Einhorn has a huge short position in Tesla. He's always bashed the company. I don't really appreciate this at all. He's trying to manipulate the stock, I think, to go down. Obviously, it benefits him. When you short a stock, essentially you bet against the stock, and that's what he's done. I would not invest in Tesla right now. They have a lot of things to figure out, but they're going to be a very, very profitable company in the future. They have a head start over everybody in the EV, the electronic vehicle space right now. Their market cap's at $37 billion. I know they're not profitable. I know they have issues. It's difficult from producing no cars in 2007, 2008 to producing hundreds of thousands of cars in 2019. I mean, you have a huge learning curve you have to get over. You have to increase employment. You have a revolutionary technology that has not been developed fully. It's going to take time. And I have said this, it's going to take time. They are a fantastic company. I think they're going to decrease over the next half year to year. I think they're probably going to float between like $200 to $270 per share. I would wait until they get over that learning curve, but let me tell you something. In the next 5 years, they are going to double in stock price. They're going to be plus 100% in the next 5 years. In the next 10 years, I think they'll probably be like plus 150% to 200%. They are a good company. They're going to figure things out, and they're going to dominate this market of electronic vehicles. I like them a lot. I would not invest in them right now. They have a lot of things to figure out. If they can get over that curve within like a year, 2 years, they're going to be unstoppable. Wait to invest in Tesla. You're going to have time to get in, and you'll be able to get them at a good price in the next couple years. Don't invest in them right now. The other big stock that I do think you should invest in is Salesforce. Salesforce is another amazing company. They came out with earnings this past week. I'll read those off right now. They had 66 cents per share versus 47 cents per share that was predicted by analysts for Q2 of 2019. Their revenue was $4 billion compared to $3.95 billion, which was expected. They bought Tableau in June, I believe, for around $15.3 billion. It was a share swap. Tableau is an analytics company. They have analytics software. I've actually used Tableau before. It's fantastic. It's a fantastic software. Salesforce, remember, deals with customer relationship management. It's the ability to manage your customer base. Combining Tableau with the Salesforce cloud is going to increase the revenue tenfold. I mean, you're going to see an exponential increase in revenue because of this. When you combine data analytics with customer retainment and obtainment methods, that's perfect. That's perfect. They go hand in hand with each other. It's an absolutely perfect fit. Another really telling metric from this whole thing is that Tableau didn't want cash. They wanted shares of Salesforce. That says a lot. It was predicted that for full year 2020, the Tableau buyout would increase Salesforce's revenue by between $350 to $400 million. Within 2 months, I believe. Now, for this past quarter, Salesforce has increased that from $350 to $400 million to $550 to $600 million in increased revenue from the Tableau purchase. And based off that, they increased their full year revenue forecast to between $16.75 billion and $16.9 billion. Salesforce is a great company. They're going to increase sales even through a recessionary period. they're going to still be profitable. Businesses need to obtain customers and retain customers, especially in a recessionary period. Their profitability is going to decrease some, of course, but they're still going to be profitable. Their market cap is huge. It's $132 billion. They have a PE ratio of 194, which is large. But when they expand to full capacity, these guys are going to be $1 trillion company. They are. They have great management. They have a great product, and they are specialists in their field. They are. They know what they're doing. I would invest in Salesforce now because they're only going to go up from here. Over the next decade, they're going to be the leader in customer relationship management over Oracle, over Google, over everybody else. They're going to be the leader. It's their specialty. That's all for the Phuble podcast for this past week. I am not going to be here next week, unfortunately, so we'll get back into things in 2 weeks. Thank you guys for watching. Happy investing, and make sure to subscribe.